Welcome to the deep dive. Today, we're really focusing on adjusting journal entries in accounting. We've got some great material here explaining accrual accounting common scenarios. The mission, really understand why these adjustments are needed.
Exactly. It's about getting beyond just the cash flow. Accrual accounting, well, it's the standard under U.S. GAAP for a reason.
Right. Matching revenues with expenses in the right period. That's the core idea, isn't it?
It is. Regardless of when the actual cash changes hands, adjusting entries are sort of the fine-tuning step. They make the financial story accurate, show the real economic performance.
Okay, so let's break down the four main types our sources cover. First up is unearned revenue, or the deferred revenue.
Yeah, that's where the company gets cash before they've actually earned it. Think like a magazine subscription paid up front.
Okay, and then the opposite almost. Prepaid expenses, also called deferred expenses.
Right. The company pays cash first, maybe for rent or insurance, but hasn't used up the benefit by the end of the period.
Got it. Then there are accrued revenues, receivables.
Here the revenue is earned. Maybe you made a sale on credit, but the cash hasn't come in yet.
And the last one, accrued expenses or accrued liabilities.
That's when an expenses happen. You've used the electricity maybe, but you haven't paid the bill yet. The cost has been incurred.
Let's make this concrete.
Yeah.
Impact Inc. They got $250,000 cash on December half in January, initially booked as unearned.
Okay, so at December 31st, year end, they've done half the work, right?
Right.
So the adjustment is crucial. You need to recognize $125,000 of that as earned service revenue and reduce the unearned revenue liability by the same amount. It clarifies December's actual performance.
Makes sense. Now, Titan Company. They paid $300 for a 3-year insurance policy, but expensed it all immediately in year 2.
That sounds wrong.
It is, under accrual. Expensing it all up front, well, it distorts the picture. The benefit lasts 3 years.
So the adjustment. You'd recognize just 1 year's worth, $100, as insurance expense for year 2.
Yeah.
The remaining $200. That becomes prepaid insurance. It's an asset on the balance sheet representing future coverage.
Okay. Titan also had $2,000 in credit sales in year 2 that weren't recorded simply because the cash hadn't arrived.
A classic accrual scenario. Revenue recognition isn't tied just to cash receipt. It's tied to when the sale happens, when it's earned.
So you need to record it.
Absolutely. You'd make an adjustment. Increase accounts receivable by $2,000, that's money owed to the company, and increase sales revenue by $2,000. That reflects the actual sales activity in year 2.
Let's circle back to Impact Inc. They borrowed $2 million. By year end, 2 months of interest have built up but aren't due yet.
Right, accrued interest expense.
Right.
Even though no cash has been paid out for the interest yet, the expense related to using that money for November and December has been incurred.
How much is that?
Let's see. $2 million at 3% annual interest for 2 months comes out to $10,000.
And the adjustment.
You'd increase interest expense by $10,000 and increase interest payable a liability by $10,000. Shows the obligation.
Okay, one more correction example. Titan got $3,000 cash in advance, but mistakenly recorded it all as revenue immediately. Turns out only 30% was actually earned by year end.
Oof. Yeah, that needs fixing. Shows why getting the initial entry right helps, but adjustments can correct things too.
So what's the fix?
Well, if only 30% is earned, that's $900. They recorded $3,000. So you need to reduce service revenue by the unearned portion, which is $2,100.
And where does that $2,100 go?
It becomes unearned revenue, a liability, because Titan still owes that service or product.
So boiling it down, what are the golden rules for these adjusting entries?
Okay, 3 key things. 1, they're always recorded at the end of the fiscal period, right before you prepare the financial statements.
From end of period.
2, critically important, they never involve the cash account directly. The cash transaction already happened or will happen later. This is about timing recognition.
No cash. Got it.
And 3, every single adjusting entry always affects one income statement account like revenue or expense and one balance sheet account like an asset or liability. Always both.
That balance is key. Our sources also mentioned other things for Titan unrecorded utility bills, prepaid rent adjustments, bad debt stuff, inventory, even security value changes. It seems like a lot can need adjusting.
It really does. And each adjustment, whether it's recognizing an accrued expense like utilities or adjusting prepaid rent, serves the same purpose.
Yeah.
Making sure both the income statement and the balance sheet are, well, accurate according to accrual principles. It gives a true picture.
So it sounds like these adjustments, even if they seem like small tweaks sometimes, are absolutely vital. They give you that true financial picture.
Couldn't have said it better. Without them, the numbers just wouldn't reflect the company's actual financial performance or position accurately.
It really highlights the difference between just tracking cash and tracking real economic activity, doesn't it?
It absolutely does. And it makes you think, doesn't it, how this whole system of adjustments dealing with these timing differences really speaks to the challenge of capturing ongoing economic reality within these neat, discrete accounting periods we use. What ethical lines might someone cross if they, say, intentionally misapply or omit these adjustments? Something to ponder.